Thanks for spending your afternoon tea time with us. We're going to try to keep it as engaging as we can. And I've got two amazing gentlemen with me. Satyam, who's the founder and CEO of LoanTap, and Mr. Mayuresh, who's the CFO and CEO of PayU, COO of PayU Credit. So we're going to focus a little bit on the digital lending side. And there's a lot to talk about. We've got about 15, 20 minutes. So we'll jump right in with some introductions and then start this. So my name is Abhishek. I was the founder of Flexi Loans and now I run Pepper Money India. We are a KKR-backed entity starting to kind of build the business in India from a consumer fintech standpoint. I'll hand it over to Satyam and then Mayuresh to do quick introductions.
I'm Satyam Kumar, running LoanTap as a co-founder and a CEO. Been in banking for last 22 years now, and that's what we are doing again at LoanTap.
Hi, this is Mayuresh. I'm the CFO and COO of PayU Credit India. Been in financial services for about 20 years. Previously, I was the CFO of PaySense, one of the leading digital lending applications. Since its acquisition by PayU, now I'm part of the PayU Credit group in India.
Thank you. I think any digital lending conversation cannot start without talking about banks. So I'm going to start with a little bit of bank and fintech relationships. And when we were talking about it yesterday, we had some interesting conversations about how that relationship has been evolving from collaboration/competition or consolidation. So I want to hear the panelists' thoughts in terms of how do you think the bank-fintech relationships are evolving over the last 5 years, and what do you think about it for the next few years' perspective? Satyam, I'll start with you, and then Mayuresh, love your thoughts.
So as we keep on saying that technology we overestimate in a shorter term, and in a long term we underestimate the technology, and that is happening as far as the bank and fintech relationships are concerned. So initially while the fintech said that we will change the world, and the bank said ki kuch nahi hota. Now banks are everywhere talking about the fintech partnerships, number of fintechs that they have partnered, the way they are opening the APIs for the fintechs to come and participate, co-create the product. So, and all of it is testimony to the fact that when we look at, all of us talking of a lending, when we look at a lending, any loan that you are doing in less than 10 lakh rupees segment is not feasible to be done on, without a tech architecture. So traditional way of going to a customer, meeting a customer, picking up the documents for doing a loan, assessing it, setting up the loan and going and collecting it. So each part we represent between underwriting, sourcing and also collections in some of the portfolio relationships. So, and we can tell you that each part is decisively different than what it used to be 5 years back or 6 years back when I left the bank. And today, as I said, that it's not something which is a wishful thinking. It's happening. Each of the banks are today dependent on an AI company. They are dependent on a sourcing platform, or they are dependent on some switches which is making the cards or some of the consumer facing applications run, even if it's in a UPI or a setting up a POS terminal or a QR code ecosystem. So the dependents are very high now, and that is what you are seeing when the banks are coming out statement after statement. So the largest private sector bank in India, or the second largest now, had a whole, I think 10 or 15 page document in their investor presentation talking about how they are enabling fintech, or how they are using the technology to build the consumer or the product for their customers. So here we are where full page of the newspapers are dedicated to fintechs, or what is happening with the fintechs, and that's not one day, that's week after week, week after week. So it's no longer that you can you can wish away. It's very much there, and we are already attracting a lot of banking talent to build the fintechs. So the tide is decisively in this direction. So that's
echo what Satyam said. See, it's a symbiotic relationship. At the end of the day, I think, as Satyam mentioned, the banks do need the fintechs, but the converse is also true. The banks really bring the deep balance sheets with lots of capital, right? Debt capital especially. So to build a loan book of a few thousand crores, you're not going to be able to do it without a bank. So even if, say, as a fintech, you have an NBFC, the funding for that NBFC has to come from somewhere, and that is by default going to be the banks, right? So willy-nilly, the banks are getting smarter about fintech, and the fintechs are also obviously learning the ropes as they go along. This symbiotic relationship will continue. I think it's one way that I look at it is if we were to take an analogy from the microfinance model, say about 10, 15 years back, they also started off as being a sideshow to the banks. Then the banks decided to fund them. Then the banks decided to acquire some of them, and now some of the banks directly do that business. We will see the same kind of evolution in the fintech lending space as well. So.
I remember 5 years ago, I was on a panel and there was one of the panelists who made a statement that fintechs today are eating from the sidelines of what banks leave behind. To today, you're talking about having a symbiotic relationship and the fact that they coexist. I think we've come a long way, and while each part of that is an important aspect that both need to fulfill, but you will see more and more of these synergistic approaches between banks and fintechs coming in. That's what we're hearing for the next 5 years. And I mean, when we talk about, again, the next 5 years, we have to talk about technology and we have to talk about data. And in the last few years, the way data has been democratized through account aggregation and new networks being created like OCEN and ONDC. If Mayuresh, you can start talking about something to do with how are you seeing the impact of this technology and this infrastructure that India Stack or the government is creating, and where do you see this going forward? Which one of these would you put your bet on and say this is going to be really big given what it is today, and there are some things that we should be watching out for and the audience should look out for?
So obviously, technology has evolved a lot, and it's not just pure India stack, right? So the Aadhaar authentication, I think a lot of us use already, so that's become mainstream. UPI was nowhere a few years back, and now look at it, it's having debit cards for lunch, right? Similarly, there are more and more applications which can be built on top of that existing public infrastructure. So in some ways, the highway is there. We have to build the trucks. So can you do credit on UPI, for example? That's the next big wave that's possible, right? There are some early starts to that using a RuPay card, but it's not in mainstream right now. It will become. So if I were to project out 3 years hence, somebody will crack it, right? Similarly, I mean, because you have things like OCEN and ONDC, even on the SME side, you will start seeing more and more people using the public infra rails to be able to lend. Democratization of info is there. Along with that ability to access that info comes greater responsibility as well. So we will see a lot more, laws around data privacy. We are already talking about that, right? We will also see a lot more do's and don'ts coming out of various regulators in terms of data storage, data localization, and what have you. But yeah, I mean, as they say, right, as the technology gets more and more complex, then so does the need for your security and your ability to protect your customer information.
So, Satyam, do you think this is making it easier to do a lending business now or making it more difficult to do? Is that an entry barrier, or how does it really shape the industry for the next 3 years?
So two parts on the making it easier is the secondary aspect. Primary aspect is just to extend the discussion from Mayur's, where Mayur left is that India, we see it is very unique. At heart, it's a democratic country, and where a lot of, as we talked of data democratization, but the public infrastructure build up itself is a very democratic structure. You can come and build a business out of the many businesses which got built on top of the UPI, many businesses which is getting built on or will get built on the health tech stack, which is getting linked to the Aadhaar stack, many businesses which will get built on top of the OCEN or GEM and other networks. So each of these networks are being created by the government or a cooperative kind of an organization ecosystem which is creating that network, and it is allowing companies to participate in that for creating a valuable product. So from that point of view, you as an institution, I don't have to spend a huge amount of money when it comes to building a likely infrastructure, which is a pan-India or encompassing such a vast majority of population and the geography that we are talking of. Having said that, one part which is the capital part is largely solved in terms of the spending on the technology build-up and all. You can bootstrap yourself on a technology side and start building it up. Where the other part is, the whole data laws, the regulations and all are now catching up, and that is making that that is now distinguishing between between good players and the players where and fly by night operators. Yeah. And that is something which has started happening in the last 2 years, where you saw digital lending guideline, draft regulations, and even the better versions of it coming. More FAQs, more clarifications came, and what you can do, what you cannot do, and which are the guidelines to follow. That clarity has come with a regulator. That clarity has come with the government bodies, and that is making fly-by-night operators operate very difficult. Okay, and the government is very on one side it's saying that, hey, the fintech is the lifeline, and the other side it is also trying to ensure that you do not have a rock players operating in the ecosystem. So from that point of view, there is a compliance cost, there is an entry barrier. You need to have a regulatory license to operate into certain markets, or most of the markets. Like a payment ecosystem was not so heavily regulated earlier. So you need to have a minimum capital requirement. Each of that safeguards are being put, and one of the safeguards is definitely a capital requirement, which makes the entry a bit higher. Besides the other confirmatory marks around fit and proper criteria of the directors, promoters, and and the nature of the money, and the whole KYC regime. So yes, the compliance and the capital cost or the capital barriers has been increasing, but thankfully the good players have come out the curve, and the industry has demonstrated the scale and profitability into it. And so you'll see a good amount of capital participation, both domestic as well as outside, coming into this ecosystem. So while the barrier has increased, it's not a constraint for good players. That is what I would want to assure.
So you're saying it's easier to set up the technology to be able to do lending, but it's more difficult to comply on the right side of things to be able to continue to become bigger and scale the business. And naturally, one part is the whole capital and the compliance side of it, but no lending business is built without having a good risk infrastructure. And it would be a shame if we don't talk about risk in a digital lending panel. What I want to understand from you is, I mean, naturally, India is a credit-starved country, so there is always going to be a product market fit in terms of credit. People need money. There will be institutions who want to give money, and that bit is always clear. It's only about how much and how fast can you collect it back. So what I want to understand from you, Satyam, if you could go first in terms of what does risk mean to you in terms of the overall importance of risk in this ecosystem, and do you think fintechs have come to a point where the risk market fit or the understanding of risk is starting to emerge?
Yeah, absolutely. So, to be honest, when we started with the business, then we started with as a banker with a collection mindset, and at the same time, many of us got challenged by the ecosystem players, which worked on an average out that, hey, if you're lending to, if this is the industry trend, so let's budget it and forget collection. Uh, Thankfully, in a very short period of time of last 5 years, we have seen so many crises that the whole world has started talking about a poly crisis, and rather than a banking crisis, or rather than talking about a liquidity crisis or an inflation or a COVID. So all those crises means basically a business gets tested on unevenness or a flaw in the idea. The ecosystem has been tested well, but at the same time, while I have migrated from where I used to be. So as a banker, I used to be obsessed with an NPA. Okay, now I have migrated to a thought process of a business case risk, and rather than pure NPA numbers in terms of the bottom line numbers. So that's one migration which many of us has done as a banker, but the banking system. The other migration, the fintech ecosystem or the technocrat ecosystem and the VC ecosystem has also migrated a bit from pure play, the overall IRR game, averaging out theory, to actually saying that it is not that, when the things goes bad, then it is not that, you will still have the average. Actually, a collection ecosystem or a bad customer ecosystem is more like an oil extraction process. So, a thick, bad oil will always take the path of the least restraints or least friction or least restriction. So the bad customer accumulate on one book. It doesn't accumulate on every book in the same fashion. More so in a digital world, because the digital world is just instant. So, once somebody cracks a code that, hey, if I put this much of info, this much of a data, then I'll be able to hack the system. Every in a next half an hour, you'll have the entire system taken up for a jack, which is not the average out of the industry. It was a specific phenomena which occurred in a particular hypothesis in a particular structure which you created. So that's where the whole the market has a new learning, and as the banker also has a new learning. And so now we have started seeing that meeting point when you have a bankers coming and working together with the fintech players and taking a risk, both a joint risk somewhere in a co-lending architecture, or even at an institution level risk they are taking, and they are coming and being a lender, indirect lender by being a lender. So the whole market in last 6 to 7 years has a very different learning than what we could have, where we all started, both side.
So what you're saying is essentially that the amount of NPA or the value of NPA is very different for different people. While for some, a 5% NPA is very high, for some it's very low, and it's the prism through which you're looking at that as a banker or a business guy. Mayuresh, I want to understand that same point of view from a CFO's point of view. When you look at a health of a business, how do you look at this? Is it a similar view or is it any different?
No, it's kind of similar. See, at the end of the day, in a lending business, you need to be profitable, right? It's not that you can perhaps burn money for 10, 12 years and then hope that someday scale will take you over the top. If you lose money on every loan, you're going to continue losing money forever, right? So that's not good in a lending business. And lending is also about leverage, right? And you don't get leverage unless and until you turn profitable. So profitability is the core of it. As Satyam kind of mentioned, therefore it depends on what is your product market fit, what's the segment. You could make a business case to lend at 12%, right? Hard for a fintech, but possible for a bank. You could make a case for lending at 16, 17%. There are fintechs who do that. You could make a case for lending at 36 also, right? And you can say that therefore 5-6% NPA is fine, right? It all depends on what segment you want to do and what are the economics of that segment. Where the challenges come to is because, again, you're in a leverage business, you need to be able to borrow from someone else, right? And if that person is not in sync with, let's say the large parts of the market are not in sync with people making 7, 8, 10% NPAs, then they find it increasingly hard to get leverage, and therefore your scale starts kind of getting limited, right? So eventually, I think the whole ecosystem will learn, as in there are different models and different prices. It's the same thing, right? You can get a pair of jeans, you can get it for 20,000, you can get it for 200 as well. I mean, it's about, what is the value that is being delivered to the customer and what is the customer segment that you're looking at.
So having seen years of lending fintech businesses being built, where I want to now take this discussion to is, where do you think the compounding effect kicks in, where a lending institution starts to become meaningful for their own size and scale? Because there will be hundreds of fintechs in the country today who will be at the 50, 100 crore AUM kind of stage, and they're not able to either raise capital because of all the things that we discussed. And then there are very large ones who continue to grow because they've learned this game, the risk understanding kicks in. For those who are building a lending business here, if you could enlighten in terms of at what stage do we start to feel that, okay, at this AUM, for this kind of product, now your understanding of the business starts to kick in and your mathematical models or your ability to borrow starts to increase?
So, that number, again, kind of varies depending on what segment you're looking at, but ballpark somewhere between 500 to 1,000 crores of AUM. is where you would probably look to turn profitable, right? The challenge is not so much the individual loan unit economics. You will probably be profitable, just on a NIM and fee basis, or even if you take out losses and cost of customer acquisition. It's really your tech stack. You will need to hire a bunch of engineers. You need to hire a bunch of product people, a bunch of data science people, right? And you need a large enough AUM to amortize that fixed cost over, and that's why it takes a fair degree of scale to be able to kind of amortize that. And that's where the scale benefits also kick in, right? So a few tweaks in your policy can lower your NPA by 50 bips, but if your AUM is only 20 crores, it's not going to pay for that data scientist, right? So that's where the economies of scale actually kick in. Once you cross that kind of threshold, then it's kind of like hitting escape velocity, right? And then your ability to attract capital, whether it's equity or debt, also changes. Again, the moment you're profitable, again, life changes dramatically. So for anyone looking to build a new fintech out there, right, in lending at least, uh, you have to keep profitability as your holy grail, because without that, you will not be able to grow it or scale it beyond a point. At least you should have a path to profitability versus, saying we'll get there when we get there. I mean, it's not going to work in this business specifically.
That's the most difficult part, is it? Satyam, any other thoughts on this? Are you seeing this play out in your business as it gains that kind of scale and momentum? Are you seeing the risk model starting to kick in and the capital efficiency starting to come in?
I think I would say we were less adventurous being in the risk business, or rather, I would say maybe we are just lucky. So for most part of the last 5-6 years, we have been profitable. So although even in the early stage when we didn't qualify for the bracket of 500 to 1,000, at a 500 crore, even RBI recognizes you as a systematically, as a mid-layer NBFC and all. So they also start increasing the, monitoring norms and all. So yeah, I mean, 500 to 1,000 is a just profitable, but yeah, I mean, 1,000 plus is really when the whole rating and everything starts kicking in. Where if you look at the four aspects of the lending businesses, by the time your CAC is in a good zone, by the time you are able to hit an OPEX of whatever sub 3% or 3% plus minus a few bips depending upon the business model that you have decided, and your borrowing cost, which is another important phenomena, it also comes under control. So three things are the key. These three things come with a scale, which is what Mayur rightly put in around. Quality of the book happens from day one and the thought process. So that's
Great. So it's almost like a full contact sport. You have to take care of everything: cost of acquisition, cost of borrowing, operational cost, and of course the technology that you build. And while everything is getting easier, it's also getting a little bit more complex. So like everything else in life, it depends. And with that, since we're at the top of the time, I'm going to ask you just one last question. In general, what are the businesses in the fintech space which you think are being built nicely, or the things that you would want the audience to go back, look at and say, okay, these are the businesses, and not just particularly towards lending, in a general landscape of fintech, what are the businesses that you appreciate?
So there's a lot of work happening on the insurance side, not just insurance distribution, insure tech, as well as digital insurance companies. I think again it's the same thing as it's an analogy to fintech lending, right? You have brick and mortar institutions which are getting disrupted by players who are more digital than not. So clearly, and some of them are acquired scale and are quite profitable as well. So that's another interesting space.
Uh, I'll hold back to the lending itself. So we see supply chain finance becoming very different than what any of us have thought. And there we see two industry getting impacted, one lending, and the second, the whole distribution ecosystem of an FMCG or a retail network, where we are seeing the unbundling of credit which is happening. It was so far dependent on the distributor of providing the credit, providing the logistics and providing the information. We are still not sure who will solve for the information, who will solve for the logistics, because the logistics are still to be proven in terms of the cost-effective or profitable manner, but the lending significantly changing to a lending institution, and that's a big change which will impact two industry, both the lending and the whole consumer movement, the consumer product movement or FMCG movement that we can call off.
Got it. Do we have more time?
Yes, we can take a few questions.
Yeah, we can take a few
Yes.
questions if we have 5 minutes. Is that okay?
Yes, absolutely.
Okay, we'll open it up for questions. We'll probably take a few questions. Please address it to the panelists that you want to ask it to.
Hello, my name is Sanket and I'm building FreeVolt. FreeVolt is basically a clean tech platform where it starts with purchase experience for the customer and then embedded finance and then ends with installations and asset management for the customer. So my question to you is, how is this financing of clean energy solutions being considered in the ecosystem?
So could you repeat the last statement again, please?
So my question to the panel is, actually I don't have a specific person to ask this question to. My question is, how is this whole sector being looked at from the lending perspective?
Do you want to take that given the... So you'll have to repeat the question a little bit more clearly,
Okay.
starting with the sector that you're talking about.
Green energy sector,
Green energy
solar and wind installation sector.
Okay. And how do you see lending coming,
Into this,
transforming that
yeah.
sector?
Oh, that's a very
yeah.
lovely development that is happening there. So we have we also have one dedicated NBFC for that. But having said that, the data availability there is much superior, much better, and it is built absolutely new. Okay, so because you do not have a legacy system or a legacy processes and all, so it's completely being done on the top of the data layer. Okay, so the financing there is going to be a breeze. Okay, today you have a bit of challenges, particularly in the sectors where you are dealing with agrarian economy and all, but I think over the next 1 year that will also get sorted. But as far as rooftop panels and all that you are talking, or even if you're talking of electric mobilities and all, each of it is, you have now huge number of interest in funding those segments, both at the capital wise as well as the lender wise and the tech wise. So it's going to be a fabulous stuff over there.
Yeah, I mean, there are people who are setting up entire businesses around green financing, and as with any new asset class that gets financed, the early birds will have to figure out some of the dynamics, right? So, I mean, if you were to take electric vehicles as an example, right? In traditional vehicle lending by now the residual life or residual value of the asset is fairly well known, right? Like a 3-year car is worth whatever. There are enough public data points that one can estimate, and therefore your lending models have evolved to build around that. Similarly, if you were to take an electric car, what is it worth in 3 years? I don't think there are very great data points. It will improve over time, but it's not mature yet. So therefore, you will expect a little bit of churn in something like this, but eventually people will figure it out. Yeah.
Great. We have a question in the back.
Hi, I'm Saurabh from Sibyl. My question first is to you, Abhishek, but will be great to get inputs from the other panelists as well. I feel that digital lending in India is coming of age, but as per you, as you fast forward 3 years, or for that matter, even 10 years, in digital lending, what segments or use cases that are funded do you see as class defining use cases or segments, right? Like when we look at digital lending, we see SME lending, we see buy now, pay later point of sale financing, we see unsecured PL, right? Any callouts in these on what will really accelerate forward and define digital lending in India 3 to 10 years down the line?
I mean, and some of this is going to be very, very personal in the sense that what are the products that I think, but in general, credit is moving towards a more sachetized credit kind of phenomena. So the way consumers consume credit is becoming a part of the overall transaction cycle. So there are 3 products that I personally feel very excited about. One is cards, purely because it allows you to create an engagement layer that otherwise is not possible in a credit category or a typical personal loans category. The second is credit on UPI, which Mayuresh mentioned, which I think is going to be big purely on the distribution of UPI and the ability to then push credit on top of that. And third, I think what I think Satyam also mentioned is the whole trade financing layer and kind of use cases like what we just discussed about green energy. How do you create new asset classes but create credit on top of it, which allow you to distribute that and sell that and create businesses on top of it? So those are three cases. If you were to ask me to put my money on kind of the future of credit, those are the three companies I would invest in.
Thank you so much for that wonderful trialogue and giving away those amazing expertise. I think that has been such an enriching and a brain-stimulating session. Let's just give a huge round of applause for this brilliant jury.